When the market has a clean breakout, it often likes to revisit that breakout point before continuing in the breakout direction. And I bet you're actively looking for these retests as valid opportunities. There's nothing new here. But here's the thing. The strategies in most trading books don't really match what the big smart money traders are actually doing. There's a big difference between where smart money sees a technical support versus our retail support levels. Breakout retests happen because the big boys are still trying to enter or exit positions. When the market breaks past certain levels, it attracts a bunch of new buyers and sellers. After breaking a high or a low, the price will often swing back to where it started. This is so smart money can feel more orders from traders betting on the breakout. Before it happens, many traders place pending orders waiting to join the move. Once the breakout goes through, it triggers all those orders. And then some smart money traders will start taking profits since they got in early before the move was obvious to us. Their profit taking causes the market to retrace back to the original breakout point. It gives the late traders a second chance to hop in, while also letting smart money lock in their gains. And that's why breakout retests tend to provide trading opportunities. Big players are still moving in and out. There's another reason why breakouts tend to retrace after a big move. It's because many traders start closing their positions too early. When the price breaks past a level, breakout traders will jump in, hoping the price keeps running. But as it comes back down towards where they got in, their profits start getting smaller and smaller. Most people probably panic seeing their gains decrease, so they bail while there's still a little profit left. The closer price trades to the breakout point, more and more traders will close out of fear. This creates a pile of sell orders that smart money can use to their advantage. Big institutions enter by picking off the orders of stopped out retail traders. Then, once they'll build their positions, the retrace will end and the move continues. It helps to see retests differently than just a retracement. They're actually the market's way of resetting itself after a big move. By resetting, I mean it gets rid of weak positions held by traders who can't handle the volatility. These are usually retailers like us who bail too early before the move really takes off. Either we panic seeing our profits erode, or trade really short timeframes just looking for tiny gains. Either way, when a retest happens, it tends to shake these weak hands out before the next wave up. After the retest, there's less resistance at that level. And now smart money have a chance to buy more at cheap prices from the stopped out traders. At the retest point, the big boys are free to drive the move further without as much selling pressure. When a drop happens, you can see the zone where a ton of traders had sell orders set beforehand. Once the downward breakout goes through, the market will usually keep falling for a bit as momentum carries it lower. And then the big money players start locking in profits on their short trades. As they close positions, it pushes the price back up towards the original breakpoint. As price moves higher, trapped sellers are bound to bail and exit, scared of losing more money, flooding the market with buy orders, their stops. And then smart money swoops in again to fill all these reversing orders on the way back up. If you think about it, no wonder retests tend to be so strong. They're capitalizing on multiple trader types, repositioning themselves. This is how the big players manipulate these patterns. Another reason why so many people struggle trading breakout retests is because the way they are marking these levels is all wrong. Most people just draw a single line where the breakout happened. But with how messy charts can be, that forces you to guess exactly which point price will revisit. which is basically impossible. And no wonder why so many retest trades end up as losses. I said it many times before, start using areas instead of lines. If there's a cluster of highs or lows in the breakout zone, I'll highlight the whole region rather than a specific price. That way, no matter where price comes back to within that area, my analysis still applies. And this takes the guessing game out of figuring out the exact retest level. As long as price re-enters your highlighted region, you can take the trade. Making this simple adjustment has made trading breakouts much more reliable. In this chart, you can see there were two highs close together that triggered breakout buys. In the moment, you wouldn't know which exact high the price might drop back to test. And that's why it's way better to highlight the whole zone between the highs instead of just drawing a line. Whether it hits the first or the second high on the retest, your area still covers it. By outlining a broad region instead of trying to pinpoint one level, you take out lots of guesswork. Marking breakdowns and breakouts as trading ranges just makes so much more sense than rigid lines. It builds in more wiggle room for when the price retraces. When trading these breakout retests, it's all about reading each market's individual tendencies. What works on one market may fail totally for another one. There's no formula that instantly makes you a pro. It comes down to watching price action over time, so you get a feel for how each one behaves. The more markets and consolidations you witness, the better calls you'll make. Also, for a breakout to be legit, you need to look for two signs. First, there needs to be a noticeable gap in the close price through the level, not just a wick. That shows commitment. And second, check the volume. If it spikes on the candle that clears the zone, that validates that buyers and sellers are stepping up. Low volume breaks are suspect. When looking for valid breakouts, volume is key. For the move to have strength, you need to see rising volume on the initial push through resistance. This shows real buying pressure forcing the break. But then volume is just as important on the retracement. It should be lower than the breakout. If volume stays high as it pulls back, that tells you sellers are still in control, and it may just be a trap. You want evidence of buying demand strengthening again. Ideally, at the retest zone, volume will start to pick up too. That confirms buyers are defending that area again. Without that validation from volume swings, it's risky to bet on the breakout continuing. Reading these volume signs is so helpful for discerning real strength versus the smart money traps. The moves need to fit the typical pattern. Break on rising volume, pull back on falling volume, and then rising again at the retest. This is the framework for analyzing potential breakouts. Breakouts that start downtrends follow the same pattern. It doesn't matter if it's continuing bearish momentum or reversing from bullish. The only difference is it breaks below support instead of above resistance. But volume should be high on the drop through the zone to confirm selling pressure breaking it. Then, you want to see a return back up to test that new area. And again, decreasing volume validates buyers aren't in control here yet. Most importantly, declining markets need rising volume too. As it extends lower, increasing selling volumes prove real downward strength. Once the buyers are unable to keep pace at the retest, look for volume to spike as the sellers take control. These volume inflections confirm healthy breakdowns versus the fake traps. When looking to enter a retest trade, it's not enough for the price to just touch the old support or resistance zone. That's barely a retest at all. You want to see some confirmation that the smart money are genuinely treating it as a new level. For me, The best way is through candlestick signals at that zone. An engulfing candle that swallows up the previous one shows a reversal underway, or a pin bar weak rejection of that area is a solid signal too. That's a much stronger indication that a new level is holding, and it's not just hovering there without conviction. Just waiting for a simple touch isn't enough evidence for me, but catching those engulfing or pin bar signals right at the old breakpoint levels up the odds the move will continue in my direction after the retest. One thing that helped improve my breakout retests is taking advantage of patterns on lower timeframes. Like this chart, I mainly trade on the 4-hour timeframe, but zooming in on the 30-minute timeframe, I spotted an engulfing candlestick forming right at the support zone breakpoint. Volume was also validating the move, with high volume on the drop and low on the pullback. So with this bearish engulfing candle plus the volume check, this would have been a pretty decent trade. Now for the stop, you have two main areas, above the engulfing candle, or you simply set a stop a few points above the whole resistance zone. So using patterns on lower timeframes for entries, but keeping the stop based on the larger zone, this can be a much safer retest strategy. One of the most reliable signals I want to see at the retest zone is a big pin bar candle. It literally screams that buyers or sellers are stepping up to defend that area. A pin bar shows up as a small body with a long upper or lower wick. This rejection at the retest shows traders are fighting over that price. Catching strong pin bars precisely where the market breaks out of a range gives such a high probability entry. The bigger the pin, the more force was in that rejection. Plus, the volume needs to be above average too. That confirms heavy volume swapping hands as buyers and sellers are battling there. These obvious pin bars that pop out at the retest zone are just begging to be traded. As soon as I see one, I'll enter with the expectation the rejection holds and the move continues. The combination of pin bars with volume spikes at the retest point is one of my go-to strategies. And I know it can be tempting to jump in right away when a big breakout happens, but being disciplined and waiting for a retest is so important. Even if you miss a few trades that keep running, that's better than entering early before letting the market reset itself. Those premature entries are riskier. By waiting, you get to see how volume behaves on the break compared to the pullback. You can also watch for solid candlestick patterns showing buyers and sellers stepping up again at the old level. And most importantly, it allows weak positions from nervous traders to get flushed out first. And then you enter with stronger footing once the area has reset as support or resistance. I know it's boring to sit on your hands at first sometimes, but patience at retest creates a much firmer base for the move to continue. Don't compromise on this rule just because the fear of missing out bites. The first initial retest after a breakout is often the most important one for me. When price first returns to a newly established support or resistance zone, that sets the tone for what's likely to follow. If it holds and bounces back in the direction of the original move, it confirms that level is now significant. But the moment it violates that zone twice, the likelihood of a new wave decreases a lot. Traders will be less inclined to defend that area if it fails as a new boundary once already. The impact is lessened. And that's why I put extra effort on how the market interacts with freshly broken levels the first time it re-encounters them. That initial test often makes or breaks the whole pattern. Oftentimes, a second retest of a breakout zone usually isn't as strong as the initial one. And here's why. When price first comes back to that area, any traders who entered on the initial breakout would still be in their positions. But if it tests again after that, they would have closed out already. So during a second retest, there's less buy or sell orders stacked up from the original breakout traders still chasing gains or protecting stops. Smart money already collected those first retest trades, so they're less motivated to defend it again. They're not hunting for as many stops or liquidity anymore either. In this chart, you can see it clearly. Price bounced perfectly off the zone the first time back down, but on the second touch, it broke through with ease. Support was weaker. So for the best odds, focus on trading that crucial first retest.